What's up, everybody? Welcome back to another lesson of High Performance Trader, and today I'm going to break down a concept that changed my life entirely, right? It's the pit number theory, right? The pit numbers, what are they, right? I talk about them all the time. I know you guys probably seen a couple videos about them where I break some down, but today in this lesson I want to break down in detail where they come from, why I use them, and the concepts behind them. Because once you understand why they're so powerful, why they work as good as they do, and why they're so effective, you guys will never trade again in the same fashion, right? So first things first, pit numbers. Where do they come from, right? So they come from the word pit. This is referencing the pits of Wall Street, right? This is where they're more like trade rooms where people used to get together. See, when we hear the word day trader now, we think monitors, we think technical analysis, we think oscillators, we think moving averages, right? We think algos, right? We think all this cool computer technology, wizardry, like craziness, right? Where people are predicting the future based on all these cool tools, right? See, back then, right, these people, these traders in the pit, they had none of that. They didn't need none of that. They just needed to understand the pit numbers, right? They needed to understand, right? And they literally had it from, TV where they'd be like, oh, yesterday's Apple's high yesterday was 107. Yeah, Apple's low yesterday was 100, right? Like they literally just had the four main levels of a candle, right? Where did the candle come from, right? The candle, which was created in the 1800s by a man of Mohisha Hama, right? He literally created the candlestick, right? And the candle is so genius. It's a very simple visual tool that literally measures price. But it doesn't just measure price. It highlights the four main price points, right? That's the high, the close, the open, the low, right? Josh, why is this important? Because you're an intraday day trader. You trade intraday, meaning you trade charts like this, right? You trade charts on lower time frames, and you probably scalp or swing the market intraday in the hopes of making money. To do this, you must buy low, sell high, right? Whether that's your options, futures contracts, I don't care what it is. You need to buy low, sell high, and to do that, you need to understand the momentum of the market, right? This is why the pit numbers are so important, right? Because look, we're trading charts like this, right? We have the open right here, price rips up, it consolidates, it rips up into a high, it rejects, and then it closes at the end of the day. Pretty choppy day there, but that's what the daily time frame candle looks like, right? And what I want you guys to notice is look how price responds the next day to these pit numbers, right? We open below previous day low. Price rallies into end of day. And look at the daily time frame candle, guys. This wick literally wicks right into end of day, where it then grabs tons of liquidity, right? We have tons of market orders, right? From people that are putting in orders after 4 o'clock, right? Maybe they're putting them in post-market, right? That's why there's all that volume that goes into the end of day closing bell price. Guys, the market is moved by price and volume, liquidity, auction, right? So it's up to us to understand how price is reacting at these levels of significance. What are they? Very simple. Listen. They're the high. They're the close. They're the open. They're the low, right? Let's bring it back to those pit traders back in the day. So when an institution or somebody wanted to make a large investment, they would call these pit traders, right? These pit traders in the pits of Wall Street, once again, in trade rooms or whatever, right? They had a connect. They had somebody that they could call and place an order, right? So when they wanted to place a large order, guess where they had to make that move at, right? You can't just put an order in at any price, because based on supply and demand, right, you're not going to be able to get that order filled, right? That means if I want to buy 100,000 shares at $100, I can't just go buy me 100,000 shares, because there probably isn't going to be 100,000 shares at that moment for me to buy, right? There might not be enough liquidity there, right? So what these pit traders would do is trade off the pit numbers, because these pit numbers hold the most volume. This is where the liquidity is, right? Real quick, without getting too off schedule here, if I pull up a chart, right, and I whip up and I go, okay, let me see the volume. Right? And I come over here and I go equities and I go, okay, show me the volume, right? Let's see where all that volume is. 9:30 candle. Massive amounts of volume in reference to every other candle. Pit number, the open. Okay. How about the high? Yeah. Massive amounts of volume up here at the high. How about the low? Yeah. Above average volume. How about the close? Massive amounts of volume at the close. See, guys, every single day, look at the close, look at the open. Look at the close, look at the open. It doesn't matter. This is where all the liquidity lies, guys. So, that's where the reference, that's where the significance comes from. It's very important that you understand this concept, right? So, let's bring it back to your chart, your intraday day trader chart, right? You have 4 main critical levels. I'm going to keep this very short and sweet so I don't waste any of your time. You have 4 main critical levels. It's up to you to figure out what large money is doing at these levels. How do we do this? Market structure, candlestick analysis, moving averages, right? Those are my 3 favorite right there, right? Everybody knows that watches my videos. I have 3-step criteria, right? It's going to be market structure. Number 1 is going to be critical level. Number 2 is going to be market structure. Number 3 is moving averages. I don't have time to go into that today, but that's my 3-step criteria. Okay. What's that first step? Identify the critical level. My first step is literally drawing 4 main price points on the chart, right? Because I know if I could then identify a break and retest off this level, right? I'm literally going to identify a extremely high probability setup, right? There's low probability setups, there's high probability setups. Think, if it's up to us to understand where the momentum's headed, right? Think about it. If price opens up below end of day, that's pretty bearish. That's a gap down, right? What's the gap fill strategy? The gap fill strategy is literally price gravitating to a pit number. Every trader out there knows what the gap fill strategy is. You create a gap in pre-market because it's sold off or it rised, and then the open bell price, which is right here, opens up. Price literally gravitates to this level. Why? Large money benefits, right? Institutions, traders, money managers, they benefit from price gravitating to this level because that's where all the liquidity is. For them to make money, they must place orders, make moves at these levels with massive amounts of liquidity. So it's up to us to learn to identify what bearish conditions look like in this scenario off this level. Right? Price drops down, comes up into previous day low, we get some buying. I see no chart pattern at previous day low, so I do not make the trade. Price then rips into end of day. We start to reject, right? This is where I'm going to start looking for trades, right? So guys, once again, chart pattern at the critical level. Learn to spot what large money's doing at the critical levels, and you will always have a massive edge. I'm Joshua Salvetti. Hope you guys liked and enjoyed this lesson. And I'm very interested in your feedback. Drop a comment below. If you have any questions, fire them away. If you want to take this one step further, check out my website. I have a whole course called Trader Bootcamp on a bunch of different concepts like this that all derive from the pin numbers. I love you guys. Happy trading. Stay blessed. You're the best. See you in the next lesson.